everyone. I'm Brian Love, the head of depository search at the Travillian Group, a boutique financial services-based executive recruitment firm outside of Philadelphia, but working nationally. My division specifically covers community banks, and I myself spent 10 years within the community bank space in the trenches, and joined Travillian 5 years ago to expand our depository executive recruitment and talent advisory divisions. We work with banks generally under 10 billion in assets on engagements centered around board and leadership teams, succession planning, and bolstering bench strength. Love to hear from any of our viewers out there if you have any thoughts on the industry or ideas for future webinars. And you can find us at www.travilliangroup.com or visit us on LinkedIn or YouTube, where you may be watching this today. So we're always looking for intriguing perspectives on the community bank space, whether it be from operational, digital, or investor standpoints. And in today's webinar, we're joined by two industry experts from private equity in a discussion about their perspective of the industry and outlook for the future. So before we introduce our distinguished guests, let me first hand the ball off to my Travillian colleague. He's our head of community bank strategy, Brett Rabatin.
Thanks, Brian. Good afternoon, everyone. I joined Travillian a few months back to help build out the bank strategy platform after being a sell-side analyst the past 20 years covering banks, and have a passion for community banking and strategic thinking. So let's go ahead and give the guys a chance to introduce yourself fully. David, why don't we start with you?
Sure. Thanks, guys. Thanks for hosting, and glad to be here. I'm David Honold. I'm a principal with Patriot Financial Partners. I've been with the firm almost 6 years. Started out my career as a bank regulator with the Federal Reserve Bank of New York, and then from there went to sell-side equity research, spent some time at Keefe, Bruyette & Woods, a firm that's probably well known to most folks here as a specialist in the bank space, and then moved to equity investment manager, Turner Investment Partners, where I spent 9 years prior to joining Patriot. So thanks again for having us. Look forward to the discussion.
Thanks, David. Tony?
Yeah, my name is Tony Scavuzzo. I'm a partner at Castle Creek Capital. Appreciate you guys asking me to join this call. I've been at Castle for about 11 years, and prior to that, actually worked at a community bank in Chicago and spent time in credit and wealth management and asset management and corporate finance before coming to Castle Creek. So my only working experience is in community banking.
Awesome. Great. Thanks, guys. So I'll start with you, David. What do you think the overall state of the bank industry is? Kind of where are we today? And what is the longer term outlook, given you guys have a longer term PE investment horizon?
Yeah, thanks. Well, it's very different than it was 6 months ago, right? We're in very different times. The impact of the pandemic has been far-reaching and deep. Certainly, the banking industry isn't immune. We're all dealing with challenges that it's created. Everything from how we interact with employees at our banks and customers, to how we're dealing with our borrowers who need some form of payment deferral, in thinking about the longer term in terms of strategic planning, potentially considering more digital forms of banking instead of physical branch location transactions. Obviously branch traffic is down significantly. So all these things are challenges, but hopefully are presenting opportunities as well for banks to streamline their operations and address some of these longer term issues. From our perspective, it's an attractive time to be deploying capital in the bank space, given where valuations are. I think a lot of banks have been proactive already in terms of raising forms of capital, including subordinated debt and preferred capital, and equity issuance may be on the way as well. Time will tell. But when we think about this crisis that the pandemic has created compared to the great financial crisis, over a decade ago, it seems at this point we have bank balance sheets that are very strong in terms of loan loss reserves and capital. I think the regulators are being very accommodating in terms of what they're allowing the banks to do in terms of various forms of deferrals and forbearance, et cetera. So we think that, although this is a challenging time for a variety of reasons, the bank group the industry overall is going to emerge stronger as a result on the back of this.
And so from a longer term outlook perspective, David, are you bullish on the sector in terms of it, returning to some positive returns and having, more towards this historic level of profitability? Or do you think the structural interest rate outlook is just going to be too hard longer term? How do you sort of gauge what banks might eventually look like?
Yeah, well, so yeah, in addition to the headwind created by the need to build loan loss reserves for potential credit issues caused by the recession, I think the flattening of the yield curve and the absolute low level of interest rates is a significant challenge as well. So, the net interest margin compression that the industry is facing is in some ways unavoidable, but I think it's hopefully not long lasting, that we do get eventually some form of relief in the form of higher interest rates as the economy recovers and there's less intervention from the Fed into the credit markets. But that's going to take time. And in the meantime, net interest margin compression is a headwind that the industry faces. And we just try to work as best we can with the companies in which we've partnered and invested in to manage through that.
Thanks, David. Tony, I had a question for you, although I wanted to just see if you had any further thoughts on that first question.
Yeah, I think David covered it awfully well. I mean, we view things very similarly. I think in the short run, though, we are still concerned, and our crystal ball is foggy. I think it's very early to declare victory yet. There are still a ton of headwinds that we need to work our way through. But longer term, we still think that this is a great sector, and community banks will survive and will thrive. But they're going to have to change the way they do business, and they're going to have to maybe get a little bit smarter or sharpen the pencil a little bit more, because the structural issues with interest rates are real. And so traded at X pre this environment, it's going to be some fraction of X that you're going to trade at. Once we get through the credit related COVID stuff, you still have this interest rate problem.
Sure. Well, let me change the subject for you, Tony. So considering talent and executive search is my sweet spot, my bailiwick, so to speak, I'm curious, how do you evaluate leadership at your banks? What characteristics are important to you, and what have you seen pre and during COVID around leadership?
Yeah, I think picking the right management team is probably the most important decision that we can make as investors, because we are in control investors in community banks, and so we need to find the right partners that can help execute and drive value. So finding the right CEOs and CFOs is really critical. And what we typically look for is someone that has a shared vision of the future, whatever that future may be for that particular company, on a commitment to be high performing. And if you're not high performing, you want to be high performing. So people that care and that are interested and want to succeed are generally the folks that we look for. And we're very lucky over time. We've been in business for 25 years, and we've got a decent Rolodex. And so when we background check folks, it's usually through our network that we can do that background check. And so we get friends to opine on folks that we're looking at investing in. We're 1 or 2 degrees separated away from someone. So we've got a really good process for that. But we've seen tremendous leadership through COVID. It's really been incredible. And the smallest bank that we are invested in is probably 300 or 350 million, and the largest is 7 billion. So it's a pretty wide asset size swath, and people have just stepped up. It's really been incredible. Whether it's organizing calls from home with 500 employees, or going into the office early because you have to just get something done and take risk by going in. But people have done some really tremendous things for each other and really for the banks through COVID. We've been incredibly impressed.
Yeah, and considering everyone is scattered, everything is virtual, and having to mobilize an entire workforce basically overnight, it's been an amazing lift. And it's funny, one CEO I talked to was getting his hair cut in the driveway by his wife. So that's the world that we're living in. Real quick though, kind of on talent, I did a non-scientific survey last week with 120 community bankers, and 63% thought there would be executive turnover either gradually or even more rapidly over the next year or two. David, I'll kind of go to you. What are your thoughts on that survey?
Yeah, not sure what to make of that one survey. I think, that there's always sort of turnover at senior levels of the banking industry. Part of that is due to consolidation, right? Part of it is due to just sort of folks moving up through the ranks in organizations and perhaps moving on to more significant roles at other banks. But fortunately, the bank industry is always regenerating talent. You always have new folks coming up the ladder, if you will. I know a lot of the positions that Travillian works with are people moving, up from a sort of operating role into the C-suite. So I think that's the nature of the banking industry.
Ryan, one thing I can tell you is, I'm not sure turnover in the traditional sense, we're seeing very much of that. But what I can say is, you've got an executive, CEO that's early 60s, had a 5-year plan forward before retirement, pre-COVID, hits COVID. And we're seeing hearing a drumbeat now for those folks saying, hey, maybe when we get on the other side of this, we should sell the bank, or, hey, tell me more about this MOE concept, right? And so I think while there's been tremendous work done and tremendous leadership, folks have been working a lot and I think are exhausted. So it may lead to turnover, but in a very different way.
I tend to agree that there's not going to be a mass exodus, but over time, as things recoup, some people that have been through multiple crises are probably going to, punch their ticket at that point. Thanks, guys.
So, Tony, we obviously know talent's important, just given everything you guys have said about it, but what other characteristics excite you about a bank when you're looking to invest? What are the things that you look at that kind of make you the most excited about looking at a particular institution?
Yeah, so I think from a fundamental standpoint, there's really 3 things that we look for. I mean, there's a lot of factors, but the 3 most important, like I mentioned, number 1 is management team, right? Picking the right partners is really critical. Number 2 is being high performing or having the desire to become high performing is really important. And then number 3, core deposits are very important to us. And, this interest rate environment is different and the economics are different, but over a long run or over a full cycle, we really believe in the value of core deposits. So really management, performance, and deposits. And then a 4th thing is value, right? I mean, we tend to fall on the value side philosophically more so than on the growth side. And so, buying things at prices that may not reflect full value is something that, gets us interested as investors as well.
And David, I'm curious, how do you invest? What are the return hurdles? And, how do you think about an eventual exit and the companies you get involved with?
Yeah, sure. So first of all, I'd echo everything that Tony said. He hit all the high points. Definitely alignment of interests with the management team, a strategy that we think makes sense and that can be executed upon. Valuations critical, and agree that the real value of a bank is in the right side of its balance sheet and those core deposit relationships. I guess that's why we're in a number of investments with Castle Creek through the years, right? So I think, in terms of return hurdles, we underwrite everything to a 5-year investment horizon. Our funds have a 10-year life. Some investments take longer, some take less, but, our goal is to get to, 2.5 times money, 25% internal rate of return. So, to echo what Tony said, we are very disciplined on valuation and on our entry price, knowing that our ultimate exit is typically going to be in the public equity markets. We're going to have a private company that we invest in that IPOs that ultimately we're able to sell for a premium in the market, or that will ultimately, the board of directors will choose to do what's in the best interest of shareholders, if that's the case, and sell to a larger institution.
Thanks for that, David. I was going to just mention something we see in the news quite a bit over the last several weeks. It seems that, a lot of banks are announcing branch closures for cost savings. And a lot of those were maybe already planned, but now are validated due to the pandemic. David, I'll go to you first, but I'd like both of your responses. What are your views on M&A as it relates to the need for branch consolidation?
Sure. Yeah, I can start. So I think, if you're to look at, the entire landscape of the U.S. banking industry, I think, what the pandemic has shown is that, branch traffic can be down and has been down significantly, as you would expect, across the country. But, banking is still occurring, right? Transactions are taking place. There's, checks are getting deposited, remote deposit capture, various forms of online banking and bill pay. People are still taking advantage of, fewer and fewer transactions are taking place using cash or check, and that is going to only increase from here as many vendors choose to do contactless forms of payment, right? So all those things are accelerating the trend towards reduced requirements for aggregate branch capacity in the United States, and I think that will be potentially among the catalysts for continued consolidation in the banking industry in the years ahead. About 3% of the industry consolidates each year, and wouldn't see any sign of that abating once we get out of sort of the stall that we're in the midst of for bank M&A because of COVID.
Yeah, I agree. I mean, COVID's just going to accelerate branch M&A, or I'm sorry, branch closures and M&A in general. There's still massive amounts of excess square foot in branches in the banking industry, and obviously the advent of technology too that changes things. But it's pretty interesting because across our portfolio, I don't know, David, what you guys are seeing, but by and large, I'd say transaction volumes aren't down as much as you would have thought given the environment. So, again, that just argues for more rationalization of branching.
Yeah, no, absolutely agree. The interruption for most banking customers has been really minimal because of the ability to utilize the digital forms of transacting.
If you can finally get, that elderly community or whatever to adapt digitally, maybe you can close that one branch that's, close to them, potentially, cost save in that regard. Thanks for that response, both of you.
Just thinking about M&A, there's already been as many sub-debt raises in just the second quarter this year as there were all of last year. So I'm curious what you guys think will be the capital raising environment. It's hard to tell with deferrals and stimulus masking, loans that might otherwise be a bigger problem. But what do you think there will be? Will there be a lot of banks needing capital for defense or offense over the next 2 years? What is your view on the capital raise environment?
You want to go first, David?
Sure. Yeah, I think the subordinated debt market's been a really good option for a lot of banks to issue, I think, proactively at attractive rates. I think that the banks that have availed themselves of that early are likely doing it to be more proactive and potentially offensive in thinking about M&A, among other things, in terms of going out and acquiring potentially in cash rather than stock that is probably trading at a depressed level right now. But subordinated debt has a role in a bank's capital structure, but it only goes so far. I mean, common equity is the highest quality form of capital. It's what the regulators like to see the most of. And, depending on the path that the recession due to the pandemic takes, we very likely could see additional capital raising that is more to shore up balance sheets and bolster loan loss reserves in the quarters ahead.
Yeah, I really agree with David. I think, the sub-debt issuance now is explainable because it's incredibly cheap optionality, right? Both for liquidity and for potential loss absorption. So it's not surprising to us that there's been issuance, but there's several paths forward. None of us know which path is going to play out. Otherwise, we'd all be very rich. But there is a path or two from here forward where you could see considerable opportunity, bank equity issuances as well. And I think it's too early to rule that out. But banks came into this with more capital and fairly decent, pre-provision earnings. It's a little different than the last cycle. But we could see a path or two forward here where there's reasonable equity issuance.
So, Tony, I had a question for you. Little bit of a different route in our conversation. We talked about it last week about FinTech and some of the disruptors in the space. And I think your opinion was that FinTech disruption is still way down the line. Not a lot of folks think it's happening right now. Although I was just reading about Customers Bank Mobile, just announced a collaboration with Google to offer digital accounts, which kind of blew my mind. So the question is, how far do you think we are from FinTech disruption, and what matters to you from a bank tech or FinTech perspective?
Yeah, so I'll start by saying I don't have anything too elaborate to say about FinTech in general. I mean, FinTech is such a broad concept. I think technology as it relates to improving efficiency of banking, I think is very real, very helpful, and will continue to be an important part of how people bank at community banks. FinTech as a company disrupting community banking, opinion is decade away before there is any material disruption. You get some on the fringe, and some will come up with a good idea and it'll have legs, but the broad industry truly being a disruptor, we just don't see that right now. And then the third angle I'd add is FinTech is an investable company for us, is almost completely uninvestable for two reasons. Number one, it's much more like venture, early stage as opposed to private equity. And number two, for one of the main reasons why we like community banking, the liability side of the balance sheet, the core deposits, the liability side, the funding side of a FinTech is completely broken, completely wholesale. And so until they figure that piece out, from a pure investment standpoint, that's not something that we would, proactively do. And I know you didn't really ask exactly that, but that's my view, on FinTech.
Great. One last question for me. I'm curious, this is kind of a once in a generational time where there's, so many strange things going on and not sure about the future with the economy. I'm curious, is there any big thing that you're working on your banks with in this difficult time? Is it, sort of the customer retention? Is there a big topic besides obviously, being safe with capital? Is there anything that's like bigger monumental that you guys are kind of really keyed in on with your banks?
I think it's something Tony mentioned earlier, which is now is really the time for community banks to shine, right? They're taking this opportunity to work with their borrowers to, implement forbearance that makes sense, to get them back on, regular payments. Ultimately, a lot of banks are coming off 90-day deferrals with a lot of their commercial borrowers currently, showing that the banks aren't a commoditized business, that they actually understand the borrowers and their needs, and especially the community banks, right? That's where they can add a lot of value. So hopefully, that's one of the outcomes from the pandemic, is that it strengthens a lot of the customer relationships and really shows the value proposition of the community banks.
That's
a great answer, David. Tony, I don't know if you want to add anything to that.
Yeah, just real quick, I'd say, first and foremost, I think folks are focused on, stressing the balance sheet and making sure that they can, withstand multiple scenarios of potential credit loss. But, I think the folks that are ahead and are maybe a little bit more progressive are really questioning the business model, right? What is our value proposition? How do we deliver on that? How many branches do we need to deliver on that? How many people do we need to deliver on that? Is our time horizon 2 years? Is it 5 years? So I think just really questioning who they are and what their value proposition is and what's the strategic plan look like. Some folks are starting to turn to those more offensive, type issues as they become more and more comfortable with credit and what's on the balance sheet.
And Tony, on that, you mentioned offense, and we talked about defense. Is there anyone doing anything right now offensively that that you've seen that resonates with you?
Yeah, admittedly, it's a lot more theory and concept right now. but there are one or two transactions that we have at our portfolio companies that are real, that are offensive. So it's not robust, but there are some shoots of offense.
Good. Okay. Well, that's actually good to hear. On that note, I think we're all finished today. I can't say thank you enough to David Honold from Patriot Partners and Tony Scavuzzo from Castle Creek for joining Brett and I today on this webinar. Thanks so much.
Thanks so
Appreciate
much,
you guys
guys.
having us.
Glad to do it.
Yeah, very glad to
All
do
right.
it. Thank you.
All right. Well, it's our pleasure. Thanks for joining all the viewers out there as well. And have a great day.
Take care, guys.
Thank you. Take care.